So good morning, Nicholas.
Good morning, James.
Evening in Hong Kong, as you are.
Yes.
So we're here to talk about Aberdeen China, which is the proposed new investment company, which is going to launch fairly soon. So I think the best thing to do is let you run a few slides just talking about what it's trying to achieve and how it's going to do that, please.
Okay, thank you again, James. If you can put up the slide, yes, that's the content of my presentation. I'm going to keep it short, basically covering three main topics: why all China, all cap, and that's followed by why Aberdeen for this all cap strategy and all China strategy, and lastly, why now. So if you go to this particular slide, the breadth of the universe is one of the largest in the world, second largest, I would say. A number of listed companies is more than 5,000. And by having an all China approach, there is no restriction on where the Chinese company is listed. As you may know, some Chinese companies are listed onshore. This is what we call the A shares, and some are listed in as far away as the US. This is what we call the Chinese ADRs. But by and large, as you can see here, the majority of the Chinese stocks are found in onshore, Shanghai and Shenzhen Stock Exchange. These two exchanges house the majority of the Chinese companies. If you go to the next slide very quickly, that is one of the nuances of investing in China. There are some sectors that are mainly available in mainland China exchanges. For example, Baijiu. I know some of us may not be familiar with that term, Baijiu. Just remember that this is the whiskey of China, as in this the hard liquor of China, and they are predominantly, in fact, I should say they are all listed only in mainland China. Then on the other hand, you have some of the big giant internet companies, the e-commerce companies. They are only listed offshore. There are some smaller ones listed in mainland China, but they are probably not very interesting from the quality angle. And then there's an overlap between the two as well. You have pharmaceutical autos that are available on both onshore and offshore, but not having any restriction on where the company is listed basically gives us a much bigger playing field, if you like, or a much bigger universe. We can choose the best stock regardless of where they are listed. Okay. Let me go to the next slide quickly again, slide 5. Now that China has gone through, in the last 10 years, I would say, a transformation from an export-led, investment-led economy to more of a service-led economy. Appreciate that is not at the same level as in the US in terms of the service sector, being the big driver of GDP. But as you can see here in this graph, highlighted in light blue, the tertiary industry, which i.e. that is the service sector, has been increasing in terms of its contribution to GDP. And this is where China will continue to restructure its economy and harness the huge potential that it has, which is not dissimilar to the US. It has a tremendous, it's a huge population, and this population is getting rich. In other words, the domestic consumption story is the way forward, and it will be a big driver of Chinese economy over the next 10, 20 years. Yeah. Slide 6, once again, another big attraction of investing in China, especially if we look at the A share, which are the onshore markets, onshore stock markets. They are not correlated with the rest of the world. I mean, last year was the case in point where China was the best performing stock market in the world. This is, if we just look at the sizable stock markets in the world, China was the best performing in 2020, and it shows the correlation with the rest of the world. That the S&P 500 correlation is only 0.5. So definitely another interesting or attractive assets that you should have it in your portfolio because it gives you uncorrelated returns. Slide 7, another reason why we think that you're not late to the game if you are still interested in putting some money in Chinese equities. Because when the day comes, when MSCI, the index provider, finally decide to ascribe 100% inclusion factor to China A share, the onshore A share markets, China will represent over 50% of global emerging markets. Now, you may ask, is this fair or unfair? I don't think it is unfair because the current allocation to China is just way too low. On a price parity, on a PPP basis, China contributes close to 30% of world's GDP, but it is only represented less than 5% in the MSCI World Index. So there is a big disconnection, if you like, between what China contributes or account for in the world's GDP versus the representation in the world's indices.
If you had to sort of guess, I mean, when do you think MSCI might put the full weighting in? And also, when do you think China may become a developed market?
Let me tackle the first question. It is a difficult one to predict. Maybe we can draw parallel with some other markets that have gone through the similar process of having their inclusion factors increased over time. It took Taiwan around 10 years to get it 100% inclusion, from 0 to the 100% inclusion factor. And it took Korea, if I'm not wrong, around 6 to 7 years. So it varies between country to country. In the case of China, it has already been quite fast because China was 0 and within 2 to 3 years, it was raised up to 20% inclusion factor. Yeah, so I know there could be other reasons to consider as well, but the China regulators, as in the stock market regulators, are very keen to open up the stock market to foreigners. Right now, foreign participation is less than 10%. I would say more like 6 or 7%. And the regulator is very keen to continue to liberate the stock market and open it up to easier access. And we have seen that already. You and I, as individual, can invest in A share, as in the onshore China, via a stockbroker in Hong Kong through the Connect program. So it's definitely much more accessible now. So there's less excuse, if you like, for MSCI not to increase the exposure or increase the pace of the exposure. Yeah.
Cool. Okay. Sorry I interrupted you. And what about when do you think it might become a developed market? How far are we away from that?
Oh, sorry. That is a difficult one. But if you look at how the government is planning ahead, China, or we can say that the party, this is the Communist Party, works on a 5-year plan. We are already into the 14th 5-year plan. And this 14th 5-year plan is actually planning way ahead of that. It is trying to attain a moderately prosperous country by 2035, 2035, which means that China wants to get out of its of the common middle income trap that has impacted on some other emerging countries historically. So that is, China is well aware of the middle income trap, and that's why it wants a to attain that moderately prosperous society by 2035. So that is the government's target. Of course, you can question whether it can achieve that, but I think what has happened between the US and China in terms of the relationship has probably accelerated the development or the strategic direction much faster than before.
Okay, thanks. Just for clarification, though, so when you talk about all China, are you including Taiwan in that?
Oh yeah, the answer is no. But then again, we have not restricted ourselves from investing in a Taiwan-listed company if we can prove that substantial amount of revenue or assets is domiciled in mainland China.
Okay.
Yeah. So it's still flexible in that sense.
Cool. Well, I've interrupted you enough. Now let's find out why Aberdeen is the right people to run all China.
Yes. So why us? Why Aberdeen for all China? If you go to slide 9, how are we different? If you look at the 9 boxes that illustrate our differentiation from the rest of our peers, and when I say peers, I'm referring to international peers who are investing in China. And of that 9 boxes, 3 are dedicated to ESG, as you can see here. ESG is fully integrated in our investment process. And as a firm, we are highly rated for ESG, given an A+ ESG rating from PRI. And at the same time, in terms of resourcing on ESG, we are one of the best or most resource firms when it comes to ESG. 20+ people, these are our central ESG team members sitting in Edinburgh, who sets the thematic framework for lots of ESG issues that we are facing nowadays. But it is implemented at the desk level through the analysts, who is the ultimate owners of ESG analysis and ESG standards, including engagement with the companies. And these analysts, our analysts, are aided by the on-the-desk ESG specialists who will help us to come up with ESG standards or ESG analysis. But more importantly, they help us to engage together with the analysts on matters that is of concern. And China is still behind the rest of the world when it comes to improving on the ESG standards. But what we like about China, especially with the A-share company, is that they are learning fast, and they want to learn fast as well, because they are very happy to have more international investors in their shareholders list, because we are known to be much more long-term than the more, I would say, fickle-minded investment managers who are in mainland China. So our typical holding period is 3 years and above. So we are the type of shareholders that they would like to have on their shareholders list. Now, very quickly going through the other differentiators, we are very large on the ground. One of the largest equities team dedicated to Chinese research. 13 of us based in Singapore, Hong Kong, and Shanghai, together with 3 on-the-desk ESG specialists. We don't have any star managers. Decision making is done by the team, so it's very much a team-based approach. High conviction. We do not sit on the fence. We focus on choosing the highest quality companies. That's why we only have 30 to 60 ideas at any one time. And this fund is geared towards premium consumption, and this is driven by bottom-up stock selection. And it does gel very well or reconcile very well with our long-term view on China, because like I said earlier on, China will be driven by domestic consumption over the long period of time in the future. Full opportunity as well, which is a key advantage of this strategy. The universe is very flexible. Doesn't matter where the company is listed. Now, slide 10, I have already described quite a little bit of the strategy. What is it? What is the strategy? How is it managed? Maybe I'll spend a little bit more time on how it is managed. Proprietary first-hand research is very important. We do not invest in a company without seeing the management. And a lot of the times you will find that we spend quite considerable amount of work, or what we call heavy lifting, due diligence on any potential investment candidates or investment targets, where we will go through not just company visits, but also talking to experts in the industry who may have some dealings with the target companies. We're trying to verify various facts to help us ascertain the quality of the company better. Because you cannot take it for granted in China where, like I said earlier on, the ESG standard is not high enough. We have to protect you and protect ourselves by getting to the bottom of the governance standard. Some family-owned businesses, we need to know about the reputation. So we try to verify that with the experts in the industry. If you are in a consumer industry, then we'll speak to a distributor, for example, to find out about the reputation of the family or of the company. So the outcome is a high quality portfolio with a higher ROE than the benchmark. And the ROE is not driven by financial leverage, is driven by operating leverage, meaning that margins are high. The ROE is not driven by excessive borrowings. Instead, the fund is sitting on a net cash. When I say net cash, what I mean is that when we add up all the balance sheet of the companies that we have selected, most of our companies actually do not need to borrow. They are sitting on net cash. So you may ask, what are we doing about those companies that are sitting on net cash? Maybe we have what you call happy problems. We are engaging with the companies, trying to encourage them to pay out more in terms of dividends. Okay. The philosophy on slide 11, very quickly as well, the definition of quality in our view is basically summarized in you can see on the right-hand side here, what we call the wheel of quality, not the wheel of fortune, but similarly, you can see that these are the 5 factors that we focus on. I've touched on ESG, so I will not spend more time on that. But very importantly, the business model, the competitive advantage, whether it is sustainable, and what is the source of the advantage. Is it coming from its branding, or is it coming from its scale, its ability to innovate through some technology, intellectual properties? So this is where we spend a lot of time deciding on, you can call it what we call the competitive moat, the width of the moat, and whether it is sustainable. Financial as well, we like companies with strong balance sheet because we are buying and holding the company over 3 to 5 years. In fact, the longer the better. So we need the companies to be able to withstand not just regulatory, but cyclical downturns that China will always go through, economic downturns. So we want the companies to be able to survive, and just by surviving, they actually increase their market share. So we do need them to have strong balance sheet and cash flow. Management pedigree, this is where our advantage of being on the ground for so long helps a lot. We have been investing in Asia, including China, since 1992. Yes, we are celebrating our 30th anniversary in being present in Asia for that long next year. And through the years of investing in China, we have the advantage of knowing which family or which even state-owned companies, which one are better and which one are not. So not all state-owned companies are created the same, and same for family companies. They are not created the same. So slide 12, why is ESG important? They are, in a nutshell, financially material. In today's world, Chinese government is not happy if the company continues to pollute. And you can see already with some of the news coming out last week that some of the provinces have been very cautious about going beyond their energy consumption targets, and as a result, they decided to force some energy intensive factories to close, as in not allow them to operate at night, all in the name of improving the ESG standards, especially on the environmental side of things. And of course, knowing the company well also means that we know what is the company's approach to ESG issues. And from analyzing those issues, you will know whether the company has a good culture in terms of being much more progressive, more modernized, trying to protect the environment as well as protect the employees. And you have happy employees, you have a happy and a good running company. So it all becomes important in our analysis. And one last thing I want to say.
Do you think, is it like an equal split between the EDS and the G, or do you end up spending more time looking at the social factors or the governance factors? Or
the G has always been there. I mean, like I said earlier on, investing in China for so long, G has always been a challenge, and we are able to get over some of the challenges because we're talking about a generational shift with younger managers taking over. Even within a family business, you have younger generation taking over, and not dissimilar to what we have witnessed in other countries in Asia, that when the younger generation take over, governance standard improve. E and S, yes, it is where there is still some room for improvement. But I would say that when it comes to disclosure in Mandarin or in Chinese, they do quite well on the environmental disclosure front, but less well on the social side. So E and G, I think they are doing much better now, but the S is where quite a number of companies need to focus on. Yeah.
Okay, cool.
Slide 13, I won't go through in great detail, but this is basically the investment process through the idea generation. We have decided not to go do deep down in terms of the market cap. So we'll have a cutoff of 1.2, 1.3 billion market cap. Companies that are smaller than that, we are facing two hurdles. The smaller companies, I would say the very small companies in China, are less institutionalized. So the quality is not good. At the same time, there is a problem with scalability as well. In China, there is a unique regulation or rule, I would say. For a Chinese A-share companies, we try not to own more than 5% of that company. Because if you own more than 5% of the company, you are required to hold a company for more than 6 months. If you fail to do that, any gains that you make from selling down above that 5% ownership has to be returned to the listed company. It doesn't come back to the trust. So that is not ideal, and that's not what we want. So yeah, the scalability is one issue there. And that's why I think we have cut off the very small cap in our initial universe. And through quantitative screening, the number of years of company visits that we have done in China, as well as some of the sector reviews that we have done, we narrow down to 210 stocks. This is what we call the working universe, the universe that we focus on, where we think that these companies are more likely to meet our quality hurdle. And with these 200 over companies, we'll do some form of due diligence. And if we believe that these companies are worth pursuing further, then we'll take it to the next step, which is the peer review. And peer review is where, the analysts would have done heavy lifting in the form of visiting the company, kicking the tires, talking to industry experts, third parties who are involved with the target company to verify certain rumors or certain facts. And that's how we end up with a peer review. Now, a peer review is not that dissimilar to a medical journal review. We get our teammates from including our emerging markets team to come up with challenges to challenge the thesis, the investment thesis. And if we do not get satisfactory answers from these challenges, then you could say that the idea has been challenged and it has failed. And companies that have passed will go into the portfolio construction process. I won't go through the detail on portfolio construction process. In a nutshell, simplistically, you will say that I would say that it is based on very common sense construction methodology. Companies that are of a high quality with reasonable valuation will be afforded a higher size in the portfolio. But of course, the usual concentration limit will come in. Not more than 10% holding in the individual issuer. So the standard will come in. But by and large, we want to have more weights ascribed to companies with a higher quality or a higher conviction. Yeah.
Cool. The next section is all about why now. But before we go on there, there's just a couple of questions we probably ask first. Yes. So first off, what's your turnover like?
Of course, this fund may not, because it's not live yet. If you look at our existing live Chinese strategy that we manage an open-ended, which is in Luxembourg, All China Fund, as well as the China A Share Fund. Both enjoy a low turnover of around 12 to 13% per annum.
Okay,
yeah.
Good. Does ESG create kind of sector biases within the portfolio?
Yes, but the biases I would say is driven more, which ESG will come in as well. It's driven more by where we can find quality companies. Now, naturally, if you think about quality, it is harder to find quality companies in, let's say, utilities or materials, especially the traditional materials, steel, aluminium. I know they also fall foul of the ESG standards, but we have underweight or we have very little in those sectors, even before we talk about ESG, because those companies are difficult to find, are difficult to call them quality in the first place. They are price takers. They are at the mercy of a commodity cycle. So it was for that reason. But of course, if you put an ESG overlay, with the carbon footprint that they have, they also fall foul of the ESG. So sometimes you will see that these lower quality sectors are also not doing so well on the ESG front. But the main driver of our allocation away from this sector was driven by finding quality very hard to come by. Yeah.
Good, thank you. Accounting scandals. So this is a thing from way back when investing in Chinese companies started to become popular, but there were a number of accounting scandals. Is this something that's gone away now, or do you still see things pop up?
No, it's always there. That's why I know we have to go through the annual reports. It is all part of our due diligence. I would say that we are one of the few houses that actually comb through the annual reports to look for accounting funnies. And a lot of the times, actually, if you look at the A share or the onshore regulators, they are not lacking in terms of the number of rules that they have, but it is the enforcement that might be an issue sometimes. And the exchanges have actually closed that weakness or that gap by hiring more enforcer of the rules. But of course, I would say that the regulators in China are still not as experienced as, for example, compared to the UK or developed countries. They are still, catching up in that respect. So it's really up to us. We do our due diligence. We talk to experts, to find out about the reputation of the family. We verify, the numbers with what the distributors of that company is saying. So that's how we try to reconcile the numbers. And of course, we can do all the usual, the first level of due diligence, check that it is a reputable auditors, and a lot of the times they are, they have partnership with the Big Four. At the same time, we look at the reputation. If it's listed for a long time, it's easier to ascertain the quality of the accounts, because if it has a lot of scandals, it would have been unearthed by the markets, stock markets by then. Another observation that I probably want to share with you is, interestingly, the further the company is listed away from China, the more likelihood that the company may have scandal or fraud. Because if you think about it, if a company is listed in the US without any other listing in Hong Kong or China, who is the enforcer? It is accountable to the US SEC, and there isn't an extradition agreement between US and China. If you commit a crime in China, the exchange in the US cannot extradite the guy all the way to the US. So that, in a nutshell, there is a loophole here, and some of the Chinese companies have exploited that, unfortunately. But it comes back, to knowing the company well. That's why seeing the management is very important. I can't emphasize more that you need to sometimes to have the X factor to tell whether, from your gut, whether this management is someone that you can trust.
Good, thank you. Right, why now?
I
think there's
yes.
a whole range of things that you want to talk about here, but I suppose we should put some of these questions to you up front, which are
yes,
the big pictures stuff, I suppose, is what's going on with Evergrande and how that might affect the economy. And also, I suppose, the increasing regulation with things like the internet stocks.
Yes. Okay. I mean, I don't think I have a lot of time, so I'll just try to keep the narrative very short. China was the first in, first out in terms of the controlling of the pandemic, which meant that China recovered quite early economically. It was first half of last year. In May, June, it started to recover. With that recovery, the government is given the headroom to relook at some of the issues before the pandemic. China started the deleveraging process back in 2016 and 2017. It was still doing that, but then the COVID hit, so they put a stop to the deleveraging. So now that they have controlled the pandemic very early on, they were allowed to go back to tackle some of their issues rather than kicking the can down the road. Now, the deleveraging is important because it does create instability to the financial system. And when I say the deleveraging, it is mainly targeted at the real estate. There's too much capital, too much wastage, sometimes you could call it that way, going into that particular sector of China. So China wants to move away from that and to curb or to reduce the moral hazard that the Chinese government will always bail out the real estate sector. So right now, the Evergrande is a case in point. It is the largest real estate company in China. This is induced by the government, and it is trying to, you can call it, teach the real estate lessons that you cannot continue to be heavily leveraged, continue to build houses based on blue sky estimation or assumption on prices that will go up forever, so as to reduce the excessive capital or credits that's going into this space. In a nutshell, China wants to move capital and credit away from real estate into more strategic areas like technology or healthcare. And at the same time, by tackling the leverage level in real estate, it is trying to resolve one big issue, and that is high housing prices for Chinese. And I'm talking about the mass population, the lower income population. If prices continue to be very high, it cannot be healthy. Society-wise, it will not be healthy. So that's where the government is coming from. So there are three main pillars that the government is trying to resolve. One is healthcare prices that are too high, or healthcare costs that are too high, housing costs that are too high, education costs that are too high. Now, the education costs, that's something that the government has tackled. So the next mountain that they want to move is housing prices. And so the Evergrande situation is an example of that. They're trying to induce a consolidation in the real estate sector, so that the players in the real estate sector would be more disciplined going forward, would be less wasteful on capital. So that is what the government wants to do, and by doing that, and prices, hopefully, housing prices will come down. No, because if capital is too excessive, that will create a situation where developers will bid very high prices for the land, and when land prices are high, property prices will be high naturally. So that's where the government is trying to instill some discipline. On the regulatory front as well, maybe you're concerned about the internet regulation as well as the e-commerce regulation. Now, this is something that is not dissimilar to what we are hearing in the West, especially the US. While we are still debating in the West, China has taken the first step to tackle the issue right on, not kicking the can down the road. So they are talking about looking at social media. Are there any influences that are not good for teenagers? Just like what we are talking about, the influences that Facebook and Instagram that is having on teenagers. So I know the regulation might be opaque, which is what investors don't like. But what the China is doing right now is not dissimilar to what is being discussed in the West. And same with the deleveraging that the China is embarking right now. Now, with so many years of quantitative easing in around the world, there will be a point where we cannot kick the can down the road further. So China is tackling that issue and starting to allow companies that are heavily leveraged to go bankrupt. Now, I don't know whether the West is doing that yet, but this is something that has to be confronted as well. I'm not saying that there's no risk with confronting this issue, because the biggest risk that I fear right now for China is whether they are able to contain the spillover effect or the contagious effect from clamping down on the real estate. It is really up to the government, how far they want to push the deleveraging, and whether they still have the levers to retract if they feel that this will cost too much spillover effect. So I think the question is really up to the government, Chinese government, how far they want to go down.
So presumably, consumers have been quite sort of heavily indebted, taking on mortgages to buy these things.
No, actually, I disagree with that. Actually, if you include the household, include the mortgage and includes personal loans, the Chinese household level of debt is still lower than what you see in the US or in Europe. It's still way below. Yeah. So it's not a classic. It's not a housing bubble in that sense. That we don't see a housing bubble in some cities, but there could be housing bubble in the lower tier cities where there are too many houses built and there may not be enough demand. But it is not heavy leverage buying by the individual or by the household that is causing this bubble. No, that's not the case. Yeah.
Okay, thanks.
So why now? Maybe very, very quickly. I know I only have 3 minutes. So these are the 5 long-term, you can say, investment trends or investment themes that we have discovered from our bottom-up stock selection. And I think I won't go through every one of them, but you'll know why I say that aspiration is a key driver of future growth in China. As the population becomes wealthier, the aspirational spending on better services, better goods, better products is there and is very strong. The next generation has a spending habit that is stronger than their parents. So this is a change that we are witnessing right now in China, and a very exciting one. Digitalization, I know there's a lot of clampdown on the internet, and this is not dissimilar to the West, but companies that are able to rectify or that have high ESG standards will emerge out of this regulatory pressure better than the smaller players. So ironically, the bigger players in China like Alibaba, Tencent, Meituan, and these companies may become stronger as everyone is put through the regulatory pressure. But because they are so large and they have the capital to increase on ESG standards, they will emerge stronger ultimately. This is our belief. But of course, in the short term, there will be pain for everyone. Going green is a very important theme that we look at, and this is where there is a lot of opportunities. China does suffer from 2 shortcomings. It has to import oil and gas as well as semiconductors. And China, given the situation with the US and China, it wants to be more self-reliant on these 2 aspects. So when it comes to the energy, they're spending a lot on becoming energy independent, and not through shale gas like in the US, but through doing a lot more on the renewable energy. China has the largest market share in terms of solar panels. 90% of the the solar supply chain is from China. So you can see that how much China is investing on renewables. Healthcare and wealth management, and then those 2 are self-explanatory because when you're richer and you are getting old, China has an aging population down the road. So the demand for these 2 areas will just be, I wouldn't say exponential, but it is definitely a huge potential when it comes to healthcare and managing the wealth in China. Why now? Very quickly on the last slide, 16, PE wise, this is lower than the world, especially lower than the US. And more importantly, the recovery in earnings is not driven by financial engineering. There's very little buyback pushing up EPS. The EPS that we see here is organic, meaning that it's driven by basically the business recovering in China over the 1 year. Yes, we might be going through a slower economic growth in the coming quarters because of the crackdown on the real estate sector. But hey, we are still talking about 6 to 7% GDP growth on a denominator that is the second largest in the world right now. So we are 6 to 7% GDP growth on a huge GDP provides lots of potential for fund managers like us or for any stock selectors. So slide 17, yeah, so basically it is why all China, the biggest advantage is that, we're not held back by any restriction. We will pick the best for you in terms of the quality of the company. Why Aberdeen for all China equities? We have a high conviction portfolio, low turnover, and ESG standards that will be in line with UK European standards. This is SFDR that I'm talking about here. And engagement is a key part of our ESG analysis or ESG process. Why now? Long-term key structural trend, as well as attractive valuation that we're seeing right now. China compared to the West might be on the opposite interest rate cycle. Because of being first in, first out, China has gone from a loose monetary policy in 2020 to a slightly tighter one in the early part of 2021. And going forward into the next few quarters, we could be seeing a more accommodative monetary policy, and that is more supportive of equities market in general. The US or maybe in the developed world, we might be seeing the opposite, where there could be a risk of more tightening or tapering. Yeah. So where do you want to be? Yeah, is my question.
Good. Well, thank you very much for that. I think we've made a better wrap up. We've just had one question pop in at the end here.
Yes, please.
Have holding any real estate companies in the portfolio?
Yeah, we have what we call a barbell strategy. We still have internet companies that is facing regulatory pressure. We still have our real estate companies, but we believe that these real estate companies are the ones that will emerge out stronger through this consolidation. And some of our real estate companies are not really the traditional real estate. Some of them are what we call real estate management companies. So they manage real estate. Some of our companies are shopping malls operators. So it is very much tied into the consumption story as well. So yeah, so we do have a different type of real estate exposure, if you like.
Well, good luck with it all. We'll be watching.
Thank you very much.
And we'll maybe get you back on after it's been running for a while, see how it's going. But yeah, thank you very much.
Thank you. Thank you for your time. Thank you. Thank you for your interest. Bye-bye.
Bye. So just to sum up what we have coming up, next week we'll be talking to Scottish Mortgage. Claire Shaw will be helping us through what's been going on with that fund, as we've had a sort of growth sell-off and what's been going on. Then on the 29th of October, Jane is going to be talking to Richard Pinder from Literacy Capital, which is one of the highest rated new issues of recent times. So it should be interesting to see what happens with that. And then we've got Rory Beckman on talking about Schroeder British Opportunities. Again, that's quite an interesting company, I think. Again, I should mention our ESG webinars are coming up. So we've got more and more funds signing up for those. So I think you may have seen some announcements already, but we'll be flagging those. I think if you want to go and sign up, the links are all on our events pages. So thank you very much for your time this morning, and I will see you next week. Bye-bye.